Good morning, everyone, and welcome to our DAT IQ weekly market update. It's our last update for August. It's August 29th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT, joined by Dean Croak, Principal Industry Analyst, and our very special guest, friend of DAT, friend of the program, and Hoosier, I might add, Tim DeNoyer.
Thanks for having me, Ken.
What exactly is a Hoosier?
No one knows. There's a lot of different origin stories for that name, and it's sort of like, Hoosier this, Hoosier that. It's a friendly. I don't know. It had to do with there is a long story behind it, and I'm going to butcher it, so I'm going to stop there.
Okay. Well, I do know that the Buckeyes will be traveling to Bloomington on Saturday, and that game will probably be rated R for gratuitous violence. I would probably assume.
It's not going to be.
But I'm looking forward to it. I will personally enjoy the most likely outcome of that.
I'm sure you will.
So for those that are new to the program, Tim, would you give a quick rundown of your title and what ACT is up to?
Absolutely. I'm a vice president and senior analyst here at ACT Research. ACT Research is a commercial vehicle data analysis and forecasting specialist. We sort of specialize in the niche of medium and heavy duty trucks and buses. And that's a pretty good start. We just had a great seminar last week with a lot of good industry attendees who came here to Columbus, Indiana, and joined us to talk about the future of commercial vehicle production, electric vehicles, regulations, a lot of that kind of stuff. Private fleets, we had the NPTC, the National Private Truck Council, spoke, so we learned some interesting stuff there. Right. And so we try to connect a lot of the market intelligence folks around the industry.
Yeah, and you're actually going the other way, right? DAT for the longest time was known as DAT, and I've always known you guys as ACT, but now you're going to ACT, so it's kind of
the branding stuff is fun, isn't it?
The mental math is hard to keep track of. And also, the one thing you didn't mention, if I'm sure most folks listening to this program have seen or read religiously the CAS monthly. You author that piece and do a lot of the data analytics for that, correct?
That's right. CAS has been another important partner of ours in great data analysis for a few years now. Yeah. Love
it. Well, great to have you. We'll bring you back in a few minutes. We're going to hop into the market update so we can leave a ton of time for discussion at the end. So we'll bring Tim back in a few minutes. And I'm going to read the notes that Dean graciously prepared. So line haul spot rates have stabilized a bit. Still very concerning. I mean, where we're sitting at from a current market perspective on the spot market with fuel cost is very precarious. Replacement contract rates for van and reefer are decreasing. That's actually kind of a good thing in a way. It speaks to a market wanting to enter that next phase of the cycle. The TIA Q2 report truckload shipments down to 1.2% year over year, while LTL shipments are down 5.8% year over year. And then Hurricane Hilary, that was Southern California, brake safety week had minimal impact. But Hurricane Idalia, coupled with kind of the growing concern around the Panama Canal and some other external factors we're watching, really have us interested in some of these exogenous events. But I think Hurricane Idalia is going to be one of the most pressing stories to watch over the next few days. So with that, I will turn it over to Dean to walk us through our market update. Dean?
Yeah, thanks, Ken. Let's hope Idalia doesn't intensify as they're predicting over the next 24 hours. So let's start with the load-to-truck ratio part of our market update. Spot market load posts continue to climb. Shippers pre-positioning a lot of freight ahead of the Labor Day long weekend. Volumes up 5% last week, still about 25% lower than this time last year. As Ken mentioned, CVSA brake safety week had very little impact on carriers. Most kept their wheels rolling rather than take time off as they traditionally do. Load-to-truck ratio up slightly to 2.91. In the refrigerated category, after dropping for the previous 3 weeks, refrigerated spot market volumes reverse course ahead of Labor Day, increasing by almost 6% last week. Load-to-truck ratio up slightly, same as dry van, up to about 4.39. Interestingly, as you can see on the chart, identical to where it was in 2019. In the flatbed category, after dropping for the previous 4 weeks, flatbed volumes are up 14% last week, but still about half what they were this time last year. Load-to-truck ratio in flatbed up from 5.29 to 6.31. That's about half the 2019 flatbed load-to-truck ratio for context. So let's have a look at some of our markets. Ken mentioned Tropical Storm Hillary did leave a trail of debris. Union Pacific's big Class 1 railroad service out to El Paso in the Midwest was broken up by bridge washouts. That'll take a few weeks. We suspected there might have been a shift in some long-haul freight volume from intermodal to truckload. That didn't materialize last week. Capacity actually eased out of Los Angeles and California. In the broader state, the average in California was down 7 cents a mile to $2.01, identical to where it was in 2019. Stockton and San Diego markets had a slight change in capacity. Rates are up slightly to $1.72 and $1.84 per mile. Both of those markets are up a penny per mile. And in the larger Los Angeles and Ontario markets, rates fell for the fourth week to $1.77 and $1.85 per mile, respectively. Remember, folks, these are line haul rates excluding fuel. In some other top 5 markets, capacity was tighter in Chicago. Outbound rates up 2 cents a mile to $1.97. They'd been dropping for the prior 3 weeks. In Atlanta, spot rates decreased by a penny per mile to $1.55, while in Elizabeth, New Jersey, rates continue to fall to $1.42 per mile last week. Having a look at the refrigerated market, we'll stay out in the Fresno market for the first part of the update, where Hurricane Hillary went through. Capacity was tight for regional loads out of Fresno to Phoenix. That's a fairly busy lane out of that market. Carriers were being paid $3.34 a mile. That's 46 cents higher than the July average and about 5 cents a mile higher than this time last year. Another long-haul lane popular out of Fresno is east of Dallas. Reefer capacity was flat, though last week rates averaged $2.22. Having a look in the Pacific Northwest, where produce season is starting to ramp up, having a look at Pendleton to Los Angeles lane, rates are up 19 cents a mile than this time last year at $1.35. On the long-haul lane from Pendleton to Atlanta, outbound reefer rates average $2 a mile. That's 14 cents a mile higher than this time last year. And in the broader Pendleton market, capacity continues to tighten. Rates in the key market area are up 4 cents a mile to $1.79. Another big market up there for reefer spot market loads is Twin Falls, Idaho. Rates averaged $1.96 last week, up 13 cents a mile in the last month. And sort of pulling back and having a look at the Pacific Northwest region, rates averaged $1.85 last week, identical to where they were in 2018. And in flatbed, we'll stay up in the Pacific Northwest. Capacity was generally tight last week in all of the markets, especially Portland. Last week, rates were up 7 cents a mile to an outbound average of $2.56. Portland to Stockton, a very busy lane for flatbed carriers, paid carriers $2.34 a mile. Portland to Denver loads averaged $2.21. That's 21 cents a mile higher than last month. And in Oregon, outbound rates averaged $2.66 a mile last week. That's 3 cents a mile higher than last year. And it's the highest for week 34, going back as far as 2016. And capacity tightened rapidly last week along the southern border in Tucson. Rates jumped 23 cents a mile to $1.70. Carriers reported solid gains for loads coming across the southern border from Nogales to Las Vegas. Rates were the highest in 12 months at $2.57 a mile. And wrapping up our market update with our year-over-year look at spot rates, the recent dry van line haul rate slide was halted last week, with the national average remaining flat at $1.58 per mile. Dry van rates have dropped 14 cents a mile since the July 4 break, but that's also in line with the historical average decrease between Independence Day and Labor Day. So no big surprise there. Last week's national average was 33 cents a mile lower than this time last year. And as you can see on the chart, sitting about 3 cents a mile higher than in 2019. Refrigerated market, after remaining flat for the previous 2 weeks, reefer linehaul spot rates were up 2 cents a mile last week to $1.97. They've dropped 11 cents a mile since the July 4 break, and that again aligns with the historical cooling in rates between Independence and Labor Day. Reefer rates are about 29 cents a mile lower than this time last year. And lastly, in flatbed, after dropping by 27 cents a mile since the start of June, the national average flatbed rate was just that, flat last week at $1.92. Last week average was 35 cents a mile lower than in 2018 and 2022, and sitting about 3 cents a mile higher than this time in 2019. That's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download the long form version of today's report, which will be uploaded this evening. It's over to Ken for the short-term forecast.
Thanks, Dean. It's going to be pretty much the same story as prior weeks, so I'm not going to spend a ton of time here. We always start with dry van. The blue line is the historical data. It's going back to March 1st here. It's a 7-day weighted moving average. It's line haul only. It excludes fuel. And then we have 4 forecast models, which is super easy to say. We've got a short-term model. That's the red line. We've got the green line, which is RateCast. That's our flagship model. It's in all of our products. And then we have a gray and a yellow line, which are intermediate models. It sort of blends both short-term and long-term trends to give a bit of a middling approach, if you will. And as you can see here, the short-term forecast is the major disagreeer. The 3 other models, with varying levels of optimism, have things stable to starting to increase over the 35-day forecast horizon. The short term is not having it. It's just down and to the right, which, again, is not necessarily a good thing, if at all. Reefer, there's much more agreement. So this next chart is reefer. Pretty much all the lines are in exact agreement. What you're starting to see as we inch along here into the 35-day horizon is by the end of September, or even the middle of September, some disagreement as RateCast starts to trend upwards based on long-term trend. I think that's a pretty safe assumption, especially given the model agreement, that there is some upside opportunity here, especially if refrigerated volumes pick up or if there's a need for refrigerated shipping based on a natural disaster type situation. Flatbed is an interesting one. RateCast has it pulling out of its tailspin, which is an emerging trend, I would say. These models were pretty much in agreement 3 weeks ago, 2 weeks ago, last week, a little bit of deviation, if you remember, deviation, I should say, and now basically pulling forward that model disagreement. If there is, and again, we hope this isn't the case, but if there's a large loss of property as a result of something like a hurricane, you will start to see these rates respond, especially regionally. As part of the recovery effort related to that. Kind of the unfortunate thing that I know Dean touched on, just to hammer home, that is a part of the area, part of the country that's very sensitive to fuel disruptions in fuel supply. So it could have unintended consequences as it relates to diesel prices. But with that, we are going to bring Tim back and get to our question of the week.
Yeah, thanks, Ken. We've got a million questions for you, Tim, but let's start with the big one that we've been tracking for the last month. Now that the dust has mostly settled, what was the impact of Yellow's demise on the LTL sector, which is, of course, a core component of your CAS shipments report?
Sure, thanks. Yeah, good question. We've started to get some updates from some of the LTL the other LTL fleets about what happened in August. I think one of the most interesting ones just came out the other day from ArcBest, who talked about reducing the amount of freight that they're taking into their network from brokerage and taking more freight directly. And their rates increased considerably. They were minus 6.4% year over year in July and turned to plus 4% year over year in August. Just like that. Yeah. I'm not sure of the comparisons, but that was a pretty big change that they reported. So I think that we did see a pretty big and fast change because it's such a large market disruption. And interestingly, that we haven't really seen much effect. Maybe for a week or so in the truckload spot market, but it seems to fade. As we know, because of the seasonal effects. But I think as the disruptions kind of pile up, adding the Yellow situation on top of the hurricane situations and more and more, eventually I think it will have more of an effect on the truckload market.
Okay.
I actually saw today, Tim, quite a bit. Sorry, Dean, I didn't mean to cut you off, but related to that exact topic, some chatter on LinkedIn that I was triangulating, carriers starting to curtail. They're kind of getting a full picture of Yellow's volume, and they're starting to sort of curtail some of the less desirable LTL freight, whether that be freight characteristics, freight class, or yield. And I think that's an interesting, pretty much exactly what you'd expect from a cadence perspective.
Mm-hmm. Yeah, we're noticing the weight per shipment numbers seem to be coming down for the other fleets who are reporting data. So it's typically lighter freight, which is interesting to see. And yeah, we're also hearing lots of stories about other modes who are picking up some of this freight. There's a lot of multi-stop truckload that's happening for tweener freight, if you will.
I mean, this is an interesting phenomenon that you typically only see in LTL, right? If it fits and it scales on truckload, that's pretty much the main decision tree. With LTL, the first time I worked in pricing for a large LTL and truckload firm. I mean, this notion of firing a customer, not because they did something bad, but just because their freight didn't fit like the characteristics of what they were looking for to maximize yield, was a totally foreign concept to me at the time. But I've grown to appreciate why they do that in the LTL space specifically.
Yeah, LTL capacity is a much more complex sort of network type situation than if it fits, it ships in truckload.
Yeah. I just remember Michael Ducker, the head of FedEx Freight at the time, was brought out of semi-retirement. He had led FedEx Express divisions for many, many years. And he said, we sell pace and space, and that's it. And that kind of made it all click, right? When you think about it that way.
And space. That's good.
Pace and space. But...
well, I do. It's okay. Good. Dean.
Yeah, it's one of the questions that's been talking about this week. Jason Miller had a couple of good posts on LinkedIn. I know you've referenced it in some of your recent cash shipments report or the broader report. But can you talk about where consumers are vis-a-vis the inventory build that we had in 2021 and the ongoing destocking of inventories and how that's playing out in both truckload and LTL?
Yeah, that's great. It's always a key topic. Yeah. We destocked inventories. If we look at the total business inventory number for the U.S. economy, we destocked. It was about 1 or 2% in the first half of the year in real terms. We inflation adjust these numbers these days, and we haven't seen a destock like that in some years. We've only seen 4 destock events where inventories were down on a year-over-year basis this century. 2016, the 2 major recessions, and 2003. And good news, every time we restocked.
Yeah.
Where are we in terms of the pace? I think we're in the late innings of the destock. I think there's some categories that are tighter than others. I think there's some retailers that are doing better than others. But overall, I think we're past the point where it's taking away freight volumes. The key for the freight cycle, the key point I like to make about inventories is as soon as the destock starts to slow, we don't have to get to a restock yet, but less destocking at this point in the cycle means more freight. And I think that's where we are, and I think it should start to help freight volumes in the months to come. And maybe next year we get to a restock kind of place, but and that's even better for freight volumes. But we don't even need to get there for it to start helping.
Okay. Yeah, that's so you mentioned next year, right? So one of the questions we get on our show fairly regularly is what's the long-term outlook? We've had reports of a non-existent peak season that kind of fits with some of the import volumes we're seeing. Are you talking about a freight recovery next year? And if so, is it Q2 before you think we might start to see some positive impact on freight volumes?
Well, here's what I would say. I think freight's a lot better than it feels like right now. I think it's already starting to recover. I think one of the reasons that the for-hire fleets in general and are not feeling it is just what's going on with private fleets. If you look at the Atlanta Fed's GDP Now tracker, it is tracking Q3 GDP to be up 5.9% quarter to quarter. A huge acceleration in U.S. real economic growth, which has been defying expectations all year. I think I talked about this on the last show. Disinflation, lower inflation has been helping real incomes recover. And that trend has continued this year, and we're seeing consumer spending start to pick back up. So I think the fundamentals are getting there. And the unfortunate thing for the trucking industry broadly is that private fleets are taking a lot of this freight sort of back in-house, if you will. we've seen lots of signs of capacity contraction from the for-hire sector. It's happening. But we also know that new Class 8 tractor retail sales are going to set a new record this year. That's all. Somebody's buying a lot of trucks. We believe it's private fleets.
Well, yeah, they've got to buy down the equipment age problem they inherited during COVID, right? I think it's not just private; it's big employee or not, big company trucks, company fleets too, that are buying down that. We talk a lot with our customers about. I mean, even adding like a 1/10 of a year to your average fleet age is a lot of trucks to buy that back down for a fleet the size of Schneider or Knight Swift or something like that. So,
the feedback
there's a lot of dynamics.
Industry at this point is that a lot of that pent-up demand from the for-hire sector is mostly satisfied, and we're getting down to smaller fleets who couldn't get as many trucks the last couple of years, who are starting to get their ages down. But these new sales, and yes, you're absolutely right, Ken, that a lot of this is just elevated replacement because the fleet worked so hard in the past couple of years, for sure. But there's definitely capacity coming into the market, and the OEMs don't feel a need to cut production yet. So truck orders over the next couple of months, we think, are going to be really, really interesting.
It's amazing that it's still happening in the face of much higher interest rates.
Yes, higher interest rates, lower freight rates. A lot of these are things are saying tap the brakes.
Yeah, but it's not.
Not doing it yet.
Tim, you had a couple of charts on the private fleet side of things. Do you want to have a quick look at those for our viewers?
Sure, you want to bring those up?
Yeah. Have a look at that first one, Ben. That might be a good way to sort of kick off this look at it. Yeah. All right. So you got private fleets are growing.
So this first one is from the National Private Truck Council, who shared this with us with last week, and there's they get a changing mix among their fleets, and they even brought a private fleet to our seminar last week to talk about what's happening with private fleets, and he had made an acquisition. So some of this growth is through M&A, but you see this big step up in the size of the average heavy duty private fleet here on the first slide, and it gives you a sense of the total growth isn't quite that magnitude year to year, but it gives you one data point suggesting that private fleets are growing. And this next slide is going to take a little bit more explaining. This is our estimate. This is an ACT Research estimate of private fleet activity based on the entire economy, the entire freight economy. We adjust the GDP data to get to our freight composite, which then we essentially subtract the Cass freight index as the proxy for the for-hire segment. And this index is what's left over, so that reflection, which is the private fleets. And the data suggests that they're starting to accelerate in their growth rates as well. So I think this is sort of the difference between that strong GDP data trend, and the 9% decline that we saw on a year-over-year basis in the Cass freight index in July, and some of that was a comp too. But Cass is still running down kind of in the mid-single digits, even adjusting for some weird comps. So we're seeing an interesting dichotomy, and I think order season, coming back to Class 8 orders over the next few months, if those calm down, that is, if we come in on the low side, then I think that suggests that a lot of freight will start moving back into the spot market next year. If, on the other hand, order season comes out and we start seeing more huge numbers, I don't think it's going to be coming from the for-hire fleets. I think that's maybe the private fleets, and that's worrisome from the medium-term outlook. Is the point that I wanted to make, and we're watching that very closely here over the next few months.
Tim, you mentioned the growth in the number of vehicles in the private fleet. Now, is that just a whiplash effect from the migration to dedicated fleets, private fleets, when capacity was tight in the last 2 years, and they're just catching up now?
Yeah, I think that's a great point, Dean. I think there's a sense out there that when supply chains sort of broke down, that shippers needed more supply chain resiliency, and to some extent that means owning more of your own trucks and putting less out for hire. I think that's what we're seeing right now. I think that how long that goes is a question. I think on the positive side, there's plenty of spot market capacity right now. Rates are low, probably well below your average private fleet costs, which does tend to be above the for-hire market in general. So you're really paying a lot for that control right now, and control is of course important to shippers, but we've built a lot of capacity, and so the risk of another real sharp contraction capacity is not huge in my view at this point. So it's really interesting to see these dynamics, but I would think freight would be flowing back into the spot market at this point, given where rates are. But it's interesting that it's still not quite. We're not seeing it quite yet.
Okay. You've got a couple of other slides there. Do you want to?
Oh yeah, one other theme we wanted to touch on would be if we want to move forward to talk about Mexico for a second. This is an interesting theme, I think, to talk about just what's happening at the border. Cross-border trucking is a real bright spot in the freight economy right now. Imports we're down over 20% in the first half and continue to be down quite a bit. But we're seeing in real terms, we've adjusted these for inflation. We saw double-digit growth last year, and even with freight volumes, pretty soft this year, we're seeing imports and exports across the border still up low single digits in real terms. And I think the interesting sort of example here is what's happened with Barbie, and Mattel built a plant down in Monterey back in 1998, closed it in 2018, and it is now their largest plant. So that is a fascinating piece of evidence of nearshoring. And the next slide shows sort of the other way, that just the data set on the first slide there showed freight going from Mexico to the U.S. My last slide, and I'll stop, throwing a bunch of data at you. The last slide is what's going from the U.S. back to Mexico. And while there is, of course, more freight coming up from Mexico to the U.S., the growth rates have been very similar over the past couple of years. So the trade balance has been very steady. So it's interesting that it's going both ways. So you can take the slides now. We can go back to a real conversation.
That's awesome. All
right. That was awesome. I'm sure that'll lead into what we're going to talk about at DATCon here. And it's about a month and a half away?
Yeah, it's coming up soon. Looking forward to it.
Yeah, it should be great. We're already surpassing our attendance numbers from last year this far out, which is pretty incredible given economic conditions. I was a little worried that people wouldn't be making the trip, but given that it's a user conference and not a vendor conference, I think that tends to make people more inclined to come out. And if you learn a little tidbit here or there that helps you price or plan a little bit better, it kind of pays for the whole trip, right?
Absolutely. It's really good to network and see what other people are thinking.
I'm sure that you do the same with your seminars, right? Because it's not a vendor conference. You go there to learn and figure out how to essentially move freight more efficiently or operate your businesses more efficiently.
Absolutely. Our seminars really do focus on the machinery sector. Our customers really want to know where heavy duty truck production is going next year, and so we do focus a lot on that and the electrification side of the business. We had the CEO of Workhorse at our seminar as well. He came out. They're pretty close by here, and they're doing some really interesting stuff on the medium duty side of electrification too. So there's a lot of interest on that part of the business among our customer base as well, and we do focus on the equipment side of the puzzle. So our seminar covers everything from used trucks to medium duty trucks to.
That's awesome. Anything from a plug perspective this week, Dean?
Yeah, a couple of things. As always, Sales Chat is on tomorrow, 11 a.m. Eastern. Robert Rouse is on Landline now, Wednesday, 7 p.m. If you haven't caught it already, the latest issue of the Freightline podcast with Chris Kaplis, he's talking to Alex Leslie from Atri on operating costs in trucking. Our very own Tamir Dov is a product manager at DAT. He's going to be on Freight 360 with Nathan Benjamin this week, talking about, on this Friday, in fact, talking about deconstructing rates, where they come from, how they're set, what are the factors that go into it. And on next week's show, we have Shannon Breen from Freight Varna talking about the evolution and expansion of trailer pools. That's it, Ken. Back to you.
Our friends at Freight Varna know a lot of those folks. Really great people, great firm. Looking forward to having them on. They're coming to DATCon. They've got a few speaking slots. I know I mentioned it a few times. It's October 10th through 12th in Houston, which should be balmy and wonderful that time of the year. I think it's the average high is going to be like 95 with 100% humidity. Right. Some folks were asking if we were going to be golfing, and I'd prefer not. But hey, if anyone wants to golf, let us know. We can put something together. Tons of great content, great speakers, present company included with Dean and Tim, tons of industry folks. And then if you use code GOBUCKS, GOBUCKS, all capital letters, you will get a nice hefty discount. But more importantly, to all of us, bragging rights for me within DAT for having the most uses of a promotional code, which is truthfully all that matters to anyone. So I highly recommend you sign up. I'd love to see you there with tons of little breakout sessions to have meetings or discussions, things like that. So highly recommend. We're going to wrap up this week. From everyone at DAT, from this show, we're positive vibes down to Northwest Florida. Listening and reading to the weather reports this morning, it sounds like it's going to be pretty gnarly. As we say every time, the best thing you can possibly do is heed the advice of your local officials. If they say get out, we highly encourage you to do that. If you're out there on the road, make sure you're protecting yourself and be safe. So with that, we will see you next week, and we'll probably be breaking down all of the impacts post Adalia on the show next week. So be safe, and we'll see you next week. Bye, everyone.
Bye-bye.
Through the course of these next 2 days, there's no better chance for us to get your input and answer your questions in one really great collaborative event.
We have so much innovation going on and so much investment, so I can't wait to share this. This is exciting. We're using AI and machine learning and intelligence so you get action right away.
It's about bringing together all aspects of the network to solve your problems.
And we know that you all move faster if you provide that connected experiences for you.
We are trying to make it easier for you to use our products. It's going to continue in 23, and this is a testament to that. With 2 million trucks in our app, all of this stuff in the network, all of the knowledge in this room, we can legitimately change this industry.